Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, January 6th, 2026, and US markets just closed at fresh record highs again. The Dow pushed above 49,000 for the first time. The S&P 500 notched another all-time high, and the Nasdaq stayed firmly in the green. But this wasn't just another melt-up led by the same megacaps. Under the surface, it was a more selective, rotational rally. AI infrastructure, small caps, and old economy cyclicals carried the ball, while a few of yesterday's heroes in big tech and energy slipped into the red. Look at the S&P Heatmap, and that rotation really jumps out. Most of the board's green, but you see those heavy red blocks and a few megacap corners. Technology is split. Microsoft and Amazon are glowing green, while Apple and Nvidia are a bit softer. Healthcare, industrials, and materials show broad, steady participation, helping the tape look healthy beyond just the usual names. And then there's energy, where Exxon, Chevron, and their peers stand out as deep red tiles against an otherwise constructive backdrop. That mix of broad green and selective red sets up an important tension. The bull run is intact, maybe even strengthening, but who's driving it is changing. AI infrastructure, nuclear and alternative energy themes, and small caps are moving from the sidelines towards center stage. At the same time, crowded megacaps and traditional oil majors are no longer automatic buys. That leaves investors walking a fine line at record levels. Stay exposed to AI and the soft landing story, but be willing to rotate, trim winners, and manage the risk of reversals in the market's most popular trades. Let's hit the rimmer tape for a minute. Palantir is once again front and center in AI chatter. This isn't a confirmed fundamental shift today. It's social media and desk talk. The story making the rounds is that Palantir is becoming a core AI implementer for governments and large enterprises, with some very bullish forecasts for a big profit ramp in 2026. That hype has turned the stock into one of the more crowded AI software trades. Price action here is less about current data and more about speculative appetite and how much investors are willing to pay for long-dated AI promises. Micron was one of the clearest winners today. The stock ripped higher, a double-digit move tied to renewed optimism around AI-driven data center demand and better memory pricing. For traders, Micron is becoming a high beta way to express the AI build-out, not through GPUs directly, but through the memory that feeds them. That strength, alongside other chip and equipment names, says the AI trade is no longer just a one or two stock story. It's broadening into the full infrastructure stack. Lam Research also had a standout day. Shares climbed solidly, reflecting growing confidence in a multi-year wafer fab build-out tied to AI, high-bandwidth memory, and advanced nodes. For many institutions, Lam Research is now part of the core playbook for the AI CapEx cycle. Add in peers across the semi-cap equipment space, and you've got a leadership cluster forming. That's important. It suggests traders are positioning for a durable, investment-led semiconductor cycle, not just a short-lived GPU spike. Microsoft continues to act like the steady hand inside megacap tech. While some peers wobbled, Microsoft stayed clearly in the green as investors favored it as a lower volatility way to stay long the AI cycle near record index levels. That stability matters. With Apple and Nvidia softer, Microsoft's strength helped anchor the broader tech complex and underscores a key point. Institutions aren't walking away from AI. They're just getting pickier about which platforms they trust at these valuations. Apple told the other side of that story. While indices sat at or near records, Apple lagged, with investors citing concerns around hardware growth and incremental regulatory and competitive pressures. In practice, Apple is being used as a funding source for more tactical bets in software, AI, and healthcare. That weakness at all-time index highs is a reminder. Even the most widely held, high-quality megacaps can underperform when the market's style preferences shift. ExxonMobil was one of the clearer drags on the day. The stock fell, contributing to a visibly red energy patch on the S&P Heatmap, even as the broader market advanced. The weakness lined up with softer crude sentiment and an investor focus that's shifting toward nuclear and alternative energy stories. While not a collapse, today's move reinforces a pattern. Capital is increasingly rewarding secular growth and transition themes, and asking harder questions of traditional oil majors at record market levels. On the nuclear side, Oklo remains a lightning rod. The stock has extended a powerful multi-day surge, fueled by enthusiasm around a so-called nuclear renaissance. and fresh U.S. policy support, including Department of Energy fuel line and enrichment initiatives. For traders, Oklo has become a high-octane way to bet on the energy transition story. But that parabolic path cuts both ways. It offers big upside torque to policy headlines and equally big air pocket risk if sentiment or the broader factor trade turns. Looking ahead, the macro calendar looms large over this rally. Labor data later this week, including jobless claims and broader employment reads, will test how durable the soft landing story really is. Inflation releases on deck will help shape the path markets are pricing for rate cuts. And housing indicators will show how quickly easier policy expectations are filtering into the real economy. Those data points can either validate the move or force a rethink on positioning. Given that backdrop, the tape feels more like trim the rip, buy select dips, than chase everything higher. Risk appetite is still strong, but investors are clearly discriminating across themes. AI infrastructure, healthcare, and industrials are enjoying more durable bids. Crowded megacaps and the frothiest AI or nuclear plays are where you're seeing profit-taking and spike risk. Into tomorrow, that argues for tactical rotation and careful sizing, not a wholesale swing away from risk. To wrap up, this is still a bull market, just with a changing cast of characters. Small caps, AI infrastructure, healthcare, and industrials are stepping into bigger roles. Traditional energy and a few megacaps are no longer guaranteed leaders at the top of the tape. The next wave of labor and inflation data will go a long way in deciding whether this rotation is a brief shuffle or a more lasting shift. We'll be watching how that plays out and which leaders the market chooses next. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.